Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Simon Somerville, manager of the Jupiter Japan Income Fund. Hi Simon.
Hi, good morning Emma.
So it's been a very good year for Japan, as a number of commentators, people in Morningstar included, predicted. They said 2015 was going to be bad for US equities and great for Japan equities. We have seen that. The Nikkei's raised from about 17,000 at the beginning of the year to nearly 21,000 today. I thought maybe we could just recap what's caused that rally.
Yeah, I think the first reason was very much domestic buying of the market. And that was, I guess, at the beginning of the year, what everyone sort of hoped for and predicted, that we would see the so-called GPIF, the government pension scheme, increase their equity allocation, which essentially is what happened. So the major buyer of the market in the last 6 months has been very much domestic. But I think that the second theme that has emerged very much over the end of the first quarter into the second quarter, and is, to me, very much an ongoing theme, is this change in capital policy at corporates. And what we mean by that is we're seeing dividends rise sharply. We're seeing a significant increase in share buybacks as companies look to increase their return on equity. And this is sort of, for us, it's something new in Japan. It's something we've been hoping for a long time. And that's been very much driving the market in recent months.
And those things are fantastic for domestic and international investors. The question, I suppose, is great if you were in it and you benefited from that rally. But for those who perhaps haven't yet taken the plunge, have they missed it? Is it too late to invest in Japan?
I hope not. I mean, the market's still significantly off its all-time highs. That theme of change in capital policy continues and will continue. We're still going to see dividends rise. We're going to see share buybacks increase. In fact, just in the first quarter, so that's in the April to June quarter, we've seen a very substantial increase in share buybacks from corporates. Companies like Toyota announcing significant large-sized share buybacks. So I think that continues to keep the market firm. Earnings are very, very strong, particularly relative to the rest of the world. So that to me means that Japan, certainly on a relative basis, looks a very attractive place to invest.
Abe is a risk, though, isn't he?
Well, there's always a risk with Abe because the stories very much surrounds him. He is one who's driving through a lot of this change in his cabinet. At the moment, his popularity is under pressure. Although I think his popularity, it's at 41% at the moment, is still quite high, but it's off from the 50% plus that we saw a few months ago. And this is as he pushes through changes to Japan's defense law at the moment. And so there's a risk, a small risk, that either his popularity falls too much and there's the murmurings in his party, or that even, and I've heard this said, that once he gets his security changes through, defense changes through, that actually he will step down. I think that's unlikely, but there is always an Abe risk, if you like, because the stories very much surrounds him.
And I think some sort of critics of the Japanese market simplify it, perhaps overly so, as purely a play on currency, which is that the yen has been weak and the dollar has been strong, and that's what's driven the rally. Is that true? And if so, if the dollar weakens, does that mean that Japan is at risk?
I think there's an extent to how much it falls. That this year hasn't been about dollar yen at all, and the market has performed very, very well without the currency really moving very much. Yes, if the yen weakens, that helps export earnings, but it doesn't really help domestic earnings, and domestic stocks have been the ones that have been performing very well. So I'm not sure it's as simple as a straight dollar yen being the driver of the market, but the yen's currently 124, 125 against the dollar. If we suddenly reverted to 110, yes, that's a risk to the market. I think as long as we stay in the sort of 115 to 125, 130 range, it's not going to be a significant factor.
Simon, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.